Okay, great. I was a little worried because, Greg, the last speaker, Greg, just had such a calming way about him that I'm going to sound like a maniac. But that's okay. Let it be a maniac. I'm more like Mark. Mark from Real Traders, he's more of a maniac. So we have. I feel at home. Let's not worry. I want to thank everybody for coming to my presentation and to this series of presentation. Mark always brings the best people on that are available, and I really enjoyed Greg's presentation. And Barry Burns comes later, who's one of my favorite. I know that those that are attending from my email to drive you here knows my affection for Barry. Just another great trader that used to hide a lot, but he's been coming out lately in the public eye, and so don't miss his presentation later on today. Okay, how about me? It's all about me now. Building and maintaining your positive self-esteem and self-confidence as a trader, I felt was a great presentation to wrap up the first quarter because especially if you haven't had the results that you've been wanting in the first quarter of this year toward your goal. This presentation, I think, will give you a little bit of grounding to why that may be occurring and how you may be able to turn that around. And I say that because I'm in the end of the business, the mental and emotional fitness part of the business that really nobody wants to be in. It's really not monetarily, it's not the kind of big bucks that one could go after when you're talking to people about what to buy and what to sell. That's what people really kind of want. They want to know what is the next best thing. What's the something that's going to make me that 10% this month or double my money in a few months or in a day or whatever. They're always looking for that next best trade. And the idea of strengthening your inner self to make you a better trader just doesn't translate to a lot of traders. And I think that that it eventually does to successful traders. And so the idea of self-esteem and self-confidence, I'm going to describe the difference, is an important concept. And then I want to talk about something called the gap also. So let's get going, and we'll wrap this up within my hour. Looking here to, I'm sorry, just trying to reduce this. I can't seem to find my arrow. I'm going to do this just for a second to move this to the side and blow this up again. Again, this is my technology, but again, because I have a high self-esteem, I'm not getting very nervous about this. So, self-esteem, definition. In psychology, the term self-esteem is used to describe a person's overall sense of self-worth or personal value. I look at this as, I'm big on gardening, and we grow probably half the vegetables now that we eat here at the house. And it not only that it makes me feel good about myself and what we're putting into our bodies here, but it also helps my self-worth. Self-worth is really the ground. It's the soil that I'm planting my seeds in. If I don't have a strong self-worth, then everything that I attempt to do comes from a weak place. It gives you a personal value. If you don't value yourself, and I think the word is deserving, and the phrase is, as far as traders are concerned, deserving of success. You need to be solid in your appreciation for yourself and that you deserve success. And that's all wrapped up in the notion of self-esteem. Self-esteem is often seen as a personality trait, which means it tends to be stable and enduring. Self-esteem can involve a variety of beliefs about the self, such as the appraisal of one's own appearance, beliefs, emotions, and behaviors. If you've ever met Mark in person, Mark is a guy that is always, he's kind of got a formal, casual way about him. He's always wearing uh, really nice shoes and a way about him. I bring that up. There are a few people in the industry that I noticed that about, and to me, that's a reflection of self-esteem. The way Mark carries himself uh, shows me when I see him. His self-esteem is reflected in the way he dresses. That's why I threw this appearance in there. It's really the first signal when I meet somebody, whether I'm dealing with somebody who has a self-concept that is strong. Now, I'm not saying that Einstein, who was probably disheveled most of the time, didn't have a strong self-esteem, but it's one of the indicators. The important part is that you need to look into yourself and if you get weak a lot, if you seem to make mistakes over and over again, that may be a reflection of an issue of self-esteem. So it's the soil that you're planting your success in. So you need to make sure that's solid. And the way we do that here at the Disciplined Trade is we have mental trainings. We use subconscious training, which is really self-hypnosis, to instill thoughts and beliefs that serve you as a trader. And some of the sessions, some of the early sessions really that we like you to work on involve this notion of self-esteem, because without it, seeds won't grow, no matter how much energy you put behind it. It really is the base of your positive belief. Now, self-confidence is a bit of a different animal. Self-confidence, the definition is confidence in oneself or in one's own ability. And I look at it as confidence implies to me a self-motivation, a pro-action. And that is, to me, is the difference between self-confidence and self-esteem. Self-esteem is the base, is the soil. And then the first motion that you take, say, as a trader in expressing self-confidence is you take that belief in your ability, your belief that you deserve the good things that are in life, and then you start to and now you're going to apply that to trading. You deserve financial success. Now it's time to apply that to trading. The first thing you may do to exercise your confidence is to spend some money on a course or make the commitment to a training. This kind of forward movement, this kind of positive pro-action is a reflection of self-confidence. So somebody who is a doubter, somebody who when I was in sales years ago in my 20s, I noticed that even when I was a waiter, I could tell people who were confident by the way they ordered. Oh, let me see, they asked a million questions about the menu, and they hide their lack of self-confidence around. They just don't, they're interested, or they want to make sure they're ordering the right thing, or the last time they didn't get the meal that they deserve, so they want to be particular. And maybe all of that is true, but I also think it's just a reflection of self-confidence. Now, my wife hates this, but when I order a meal at a new restaurant, especially, or one that I know where the reputation is good, I will not open the menu, and I will look at the waiter and I'll say, order me. What I say is, ask the chef that if a family member was sitting here right now, what would they put in front of them? And I said, and I tell them, even though I know you, the waiter, have an opinion of what you want, I want you to ask the chef, what looks good tonight to put in front of me, and I'll have that. Now, most people look at me like I'm crazy if I'm with other people and I do something like that, because I do it more than I don't do it. And I think it's because I have a particular confidence, because I know about the restaurant and I love surprises, and I have a wide range of acceptance in what I'm willing to eat. I like fish, I like meat, I like everything. I even like anchovies, and I like durian. I like things that people generally don't like. I don't know a food I haven't tried and at least feel pretty good about it. and so I have a confidence knowing that if I don't restrict the chef, he's going to put something that's really fresh and really nice in front of me. That's confidence, the proactive nature of what you do. So if you have a self-esteem that underlies your feeling that you are deserving, and you combine it with confidence, the proactive nature of doing the right thing by yourself toward your goal, then you're going to wind up with a combination of attributes and really a core, because your self-confidence and your self-esteem are the basis by which everything else operates. And so you got to have this before you can work on things that are learned talents or learned skills, like pulling the trigger without hesitation, or having patience to wait for the A+ trades, or taking your losses in stride, or not moving your stops because they're part of your plan, and you as the disciplined trader will follow your plan. This kind of confidence is seated in the ability to make those decisions as a self-confident person, but even before that, have a serving ground, a ground by which you can sow those seeds, and that's your self-esteem. I need to do this again. Hang on one second. Whoops. Okay, I'm going to cancel this. Hang on. It's asking me if I want to leave the webinar. Okay, I just don't like that sidebar there. Okay, unless there was something they wanted to tell me, of which hopefully you'll Skype me. All right, let's get going here. Self-confidence in one's ability, we went through that. A strong, positive self-confidence is critical to your ability to move forward successfully toward your goals. We're going to get into that a little bit more. So I hope that you understand those differences, because a strong, positive self-esteem, having some, when I plant things now, I put the nutrients right in the initial soil. I used to kind of sprinkle them on top, but I've learned it makes a more powerful soil, and in our case, a stronger self-esteem if you embody thoughts of deserving yourself. Deserving success as a trader, and of course a strong positive self-confidence. You combine those and you're going to have a success base as a trader, and which will translate into a strong positive expectancy. So to maximize your strong positive expectancy, here are two things, and I named them both one because they're both equally important. One is paying attention to money management and risk management. And this exercise, we're going to talk about money management and risk management in the context of emotional risk, and staying out of the gap, which is a concept I want to give to you that I paid a lot of money myself to achieve. And I'm going to tell you about that. It's an important concept. But let's get into the money management and risk management first. As far as money management is concerned, how much of my account am I willing to lose in order to have a decent chance for the return that I'm looking for? Okay, so this is always the question. What kind of, I know what I want, how much am I willing to lose? Now, one of the main elements that, as far as the answer to this question, or the, how much risk are you willing to take, is the question of position sizing. It determines expected drawdown and annual return expectations. Most people don't pay enough attention to position sizing. When they're doing well, they tend to increase their positions, and when they're doing poorly, they tend to decrease their positions. And I guess there is some wisdom in that. And if you've expressed that wisdom as part of your trading plan, then it makes sense to follow that. It makes even more sense. However, for me, when I'm winning, and I've taken profits, especially a big one in my first trade of the day, say I'm trading for 2 or 3 hours, I take the notion of defending that profit and not taking more risk. I'm not increasing my position size. In fact, I do the opposite. In fact, what I do is I do things to maintain that position size. Yes, I know that you want to maintain the positive momentum, and if you're winning, let it ride. But I think that the important point here is that you need to engage the question of risk and money management to something that fits you. I mean, I understand those people that add positions as trades are expanding and trends are being established, but it just doesn't suit me. It doesn't fit me. I mean, it fits me to follow trends because that's the main thing that I do. But I like to try to get to them early and get into that initial pop. So position sizing, however you handle it, has to be congruent with your trading plan and what that means to you. So let's look at the maximum emotional risk. So maximum emotional risk meaning deep stops and a high number of positions. If you have deep stops, it means you're willing to take a larger amount of a larger loss on each trade. If you have a high number of positions in your position sizing, it means that you're risking more. Maybe it allows you to scale in, scale out, but if you're heading in the wrong direction early, then you have a high number of positions that are getting hurt. You combine those two, and you're going to have your highest, your maximum emotional risk. Now, if you're familiar with the shape of a hammer or shooting star being on the top of a run, and the hammer, say, being on the bottom of a run, hammer being a small head with a long tail when you're looking at a candle formation, the long tail pointing down, those tails can be very long. It's a very powerful reversal signal on a trend, but those tails can be very long. In fact, the longer the tail, the stronger the signal is, mostly, not all the time, but mostly. And so it behooves you to understand that although you're getting a strong signal, if you're putting your stop below the bottom of that tail, in the case of a hammer, then it makes sense to measure that risk and possibly avoid the trade because of the problem of the risk. Again, I'm going to leave it like this. I'm sorry I keep doing this, but I keep seeing this window pop back. So if I just do this a couple of times, I'm not going to forgive myself for it from here on in. So, if you're right about deep stops and a high number of positions, you get a big score, and that's a good thing. Although it may not be a good thing, and I'll tell you why. And if you're wrong, it's like a punch in the solar plexus. So having in your trading plan deep stops and a high number of positions as an early approach, I don't believe is a wise thing. Because even though if you're right, you have a big score, the problem is that if you get that big score, somehow it tells you it's a good thing and a wise thing to do. And the more you think about it, the more you trade, the more you'll see that if you keep your stops fairly short and you keep the number of positions standard mostly and only increase under certain extreme conditions that are stated in your trading plan, then you're going to wind up having a better time of your trading. Shallow stops and low number of positions are the opposite. This is the minimum emotional risk. The pro, of course, is that if you're wrong, you're not going to take a big loss. You've got short stops and you only have a couple of positions on, or whatever the smallest number of positions in your position sizing that you could have to run your trading plan effectively. The con is, if you're right, you're not going to make much money, and you're kind of frustrated because you could have made much more money if you had a decent amount of positions on and you let the thing run a little bit. So the problem with defending against all the risk is that you're shutting off the opportunity for profit. So the best solution is to inspect yourself and to determine what you can handle and what you can't at this moment of trading. And I mean, you may think you can handle more risk, but if you look back at your history of handling more risk, just saying to yourself, I won't make that mistake the next time, is not good enough. Unless you're training your mind, unless you are employing new neural pathways, instituting new neural pathways with the messages of being disciplined and running your trading plan without hesitation and without question, as opposed to hesitating to take your losses or to take a trade when you get the stimulus from your trading plan to take a trade. To think you're going to change is not going to happen. It's a dream, and that's why people blow out accounts over and over and over again. They think by gritting their teeth and clenching their fist and this time and saying it with enthusiasm, I'm not going to make that mistake again, and they make it again. These are the people that blow out accounts over and over. There are very few alternatives, and in fact, I know of no alternatives than training your mind for the best result. I think I think I have a different solution for this situation, and because I'm using a player, which gives us the best result, I'm going to minimize this. How's that for a geek who is not really a geek? So we went through all of this, and I think you have. I think I've covered that pretty effectively for you. The idea is that I want to take just a moment and just talk about how the most effective way to trade your mind. I've been helping traders to be more disciplined for almost 2 decades now, and we've developed a 7-minute mental training session on each particular core mental talent or mental skill of a trader that can build that mental talent for you. And the process is simply to take a few deep breaths, close your eyes, and allow yourself to listen to just an audio of positive statements constructed in a way that we've learned over time is the most effective and quickest way to make that neural pathway stick, and to multiply those neural pathways as you continue to take these 7-minute trainings once a day. And what happens is the neural pathways build into a neural net with enough neural pathways. That neural net is now the controlling factor by which you'll make decisions. Whatever your subconscious mind believes is true for you, that's the basis by which your conscious mind will make decisions. So when you're given a stimulus by your trading plan to take a trade, the response from your conscious mind, the decision maker, to make that trade or not make that trade, it will look to your subconscious mind to see what is true for you and in your best interest. And if you've built enough neural pathways that say, I'm a wise and disciplined trader, I do the things that my trading plan tells me to do. I'm a wise and disciplined trader, and I do the things that a wise and disciplined trader does. And all those kinds of positive notions that are imprinted in your mind that serve you as a trader. When the stimulus happens to take the trade, your conscious mind will look to your subconscious mind, looking for the dominant neural net, and take that trade without hesitation. It happens in a flick of an eye. Okay, it happens in a millisecond. So, see, because right now, before you do that mental training, the fact that you're not taking the trade without hesitation is because you're operating on a dominant neural net that your subconscious mind believes serves you, but doesn't serve you as a trader. And it may be a neural net that's been formed by long ago as a child. You may have been listening to your parents argue about the stock investments. Your mother may have been yelling at your father, or vice versa, about how you can't keep losing money in the stock market, and how you've got to stop, and they were both yelling at each other, and you're standing at the top of the staircase listening to it secretly in tears. Those kinds of imprints that trading is not good, even as a 4-year-old, 5-year-old, 8-year-old, 10-year-old, whatever. This or a big loss that you had as an adult, these kinds of emotional imprints also create neural nets, neural pathways, but they're strong neural pathways which sometimes create instant neural nets. And you're still operating on that because you haven't submitted anything to your subconscious mind that's in opposition to that thought which is not serving you as a trader. So one way to, the emotional state is a way to create it. The other way is to get yourself in an alpha brainwave state, which kind of pushes your conscious mind to the side and allows your subconscious mind to take in those neural pathways and imprint and start to build a neural net. And it doesn't take long. These 7-minute sessions that we offer over the course of 2 weeks, even if you take it 1 7-minute session a day, which is really relaxing and fun, and you do that for 2 weeks, 10 trading days, that's enough neural pathways to secure the new neural net and then have you operate in a way that serves you as a trader when you get the stimulus from your trading plan. Okay, so the best approach I find, as far as balancing the number of positions and so on, is to be patient and wait for the ideal A+ setup, what I call A+ trades, to enter a trade where you have a high profit potential and a low loss potential. Okay, size your positions according to the spread between the risk and reward. In other words, if you have a 1 to 3 risk reward or 1 to 4 risk reward, that in many trading plans is the indicator to whether you're going to take on 3 positions or 4 positions, for instance. All parameters should be committed in writing to your trading plan. Okay, so you're sizing your positions according to the risk-reward spread. Now, I need to define here what an A+ trade is. An A+ trade to me is a trade that, by experience, nobody can lend you or show you an A+ setup. An A+ setup is one that you have experienced, that when you take that trade, it has resulted in very positive results for you. For me, engulfing patterns for reversal patterns that fall into the A+ trade category are hammers at the bottom, shooting stars at the top, and engulfing patterns at the top or the bottom. I won't go into what those are right now, but for all intents and purposes, just know that they are strong reversal patterns. Now, the world knows they're strong reversal patterns, but I think they can be misused. I don't take them all, because that's the first part of an A+ trade. The second part of an A+ trade is the length of the tail compared to the prospect of what I want to achieve. Now, the length of the tail may cut me out of because I always put my stop at the bottom of a hammer or at the top of a shooting star, which can sometimes be excessive. And if that measure is above 2 or 3% of the value of my account, I'm not going to take that trade. It doesn't meet an A+ trade. So as long as I'm risking less than 2% of the value of my account on a trade, I have an A+ reversal formation. Okay, and the timing is right, the time of day and other factors of timing. That is what, to me, equates to an A+ setup. It's going to be different for you. All I'm saying is that you need to determine, not by I think I remember when, start now to inspect what works for you and what doesn't work for you, so that you can arrive at what an ideal setup is for you. And by making that ideal setup for you, you're going to wind up seeing that you're going to be having the patience to wait for ideal setups. You're going to have a lot. Your success ratio is going to be a lot higher, and your win rate, you're going to be winning a lot more than you're losing. But it takes patience. Sometimes you won't trade for a day, 2 days, 3 days. But think about it. How many times have you spent all day trading just trying to get an initial loss back on a trade that was not an A+ trade? Sticking to A+ trades is really the way to go, especially for new traders. But I think that me, and I'm not far from a new trader, I'm still doing it because it works. Okay, so, and here's one of the reasons I don't like to take big drawdowns or big trades, and everybody has seen this chart. I want to emphasize it. If you have a 10% drawdown in your account, this is why I keep my individual trade limits between 2 and 3%. I don't want to take any more loss than that on a trade. If you have a drawdown in your account of $10,000 of 10%, then it takes you 11%, little over 11% to recoup that loss. That's not so bad. I still don't like being behind the 8 ball, but it starts to get bad at about 20, 25. At 20%, you need to see a jump of 25%. At 30% drawdown, if you let yourself get into a 30% drawdown, you're going to need almost a 43% response in your trading positive from then on in to just recoup the 30%. Well, at 40% and 50% gets really bad. You got to double your account, and I've seen very few traders who have gotten below 50% who have recovered, because mentally it just is you quickly go to the busted stage and say, I'm going to try again. And this is why I like to keep keep my losses per trade low, and this is why I have a sticker on my monitor right now that says, "Be patient, wait for the A+ trades," because the A+ trades just puts you in. It gives you the right combination of metrics for the ideal to enter a trade. Okay, so crop this, and you can. I think if you're an Apple user, you can go Command-Shift-4 and just frame this and print this out and remind yourself that you need to defend against losses. Okay, I'd rather be out of a trade wishing I was in than in a trade wishing I was out. And I think Mark Nichols once said that, and I remembered it. Or maybe it was Albert Einstein. All right, here are my personal rules for capital preservation. And these are not anybody else's rules, and not everybody will agree with these rules. But they're my rules for capital preservation. I'm very shy about pyramiding. I only pyramid winning positions, and only when they continue to reflect favorable risk-reward ratios. I never average down. We held back in 2011 at the Trump Hotel. We held a discipline trading lifestyle event, and I had a bunch of speakers there. One of them was Steve Nissen, who talked about that he discovered something really interesting. That when he saw at the bottom of a run, when he saw that hammer that I described at the bottom of a run, that most of the time the market will retrace into the tail before it responds to the positive action perceived by that hammer, and that he was no longer buying right after the formation of the hammer. He was waiting a tick or a bar or two to buy, because he felt that it was a high probability of moving lower. I don't care what he thinks. I mean, I do care what he thinks, but I have a strong self-esteem and self-confidence in the way I do things, because it works. And it's interesting to me, but it still doesn't mean that when I buy after the hammer formation and the market comes back, I'm going to add a position, because now I have a shorter risk and a bigger profit potential, because the market backed off just like Steve said it would. Even though I respect Steve, and I mean, he's one of the best at candlestick charting. He's better than I am. I know that. I mean, he makes it a religion, but I have my own religion, and that's be shy about commandment 1. Be shy about pyramiding. Winning positions, I will do it every once in a while in a very unique area in my trading plan. But to me, it doesn't make sense to put on a position that's higher when you've already seen the market move in your favor. I would rather just feel good about the fact that I got a position or two on. I'm feeling really good about the profit I have. Why risk any of that profit? Why, I have a good thing going. I don't mess with it. Now there are a lot of great trend followers that smarter than I that will continue to pyramid positions on the way up. All right, do it, and they got good reason for it. The longer a trend goes, the stronger it is. The more the shorts are getting squeezed out, and they're going to have to cover. And you see that big run up. Okay, that's the time maybe to get out. And all of that makes perfect sense to me. But I'm not going to do anything about it in my own trading, because I have my own way of doing things. And one of the expressions that we have around here is, I'm a wise and disciplined trader, and I do the things that a wise and disciplined trader does. In fact, we have a flashpoint button that we sell on our site, The Disciplined Trader, and here it is.
I am a wise and disciplined trader, and I do the things that a wise and disciplined trader does.
My wife is the voice of all of our sessions. That's and when somehow I feel that maybe I'm feeling a little weak commitment wise to I just hit the button, and I'm a wise and disciplined trader, because there are a lot of people smarter than I am as far as trading is concerned, but I don't think there are many that are wiser. And my wisdom comes from the fact that I have inspected myself, and I know myself, and I know what works for me. I know what I blame myself for when I do the wrong thing, and I know what I'm most proud of when I do the right thing. And my trading plan and your trading plan should reflect what you believe is right for you and nobody else. Not me, not Mark, not Barry, not anybody who's going to be speaking today, or anybody that you ever heard. It's all about you. This is all about you. I'm not going to write you a check because you lost money. So I'm not going to get into that, other than saying this is what I do. And I do it because it fits me and my emotional profile. And it makes sense to me. Okay? Risk only a small percentage of the total equity of each trade, no more than 2% of your portfolio value. We've talked a little bit about that. I will move it to 3% from time to time in certain futures markets. 2% just is a little tough on some of the larger contracts. But risk only a small percentage of the total equity of each trade. And it's going to take patience. It's worth it, people. It's worth it to stick to a maximum you're willing to lose on a trade. Now, I trade a lot of futures and I trade a lot of stocks, and what that means to me is that I'm often involved in 2 or 3 positions at the same time. I seem to always be trading the S&P, and then sometimes I'll be in a soybean position, and then I see something happening in gold, and I'll take a position there, and I see a stock I like. So sometimes I'll be in usually not more than 3 positions at a time. So in that particular case, if I'm not going to risk any more than, say, if I stick to the 2%, I'm not going to risk any more than 2% on each trade. Then, if I'm risking 2% on trade number 1 and 2% on trade number 2, I can't risk any more than 2% on trade number 3. Let's take I think a better example for this 8% figure. If I'm going by that rare occurrence that I have in my trading plan of taking no more than 3% of the value of portfolio in a trade. So if I'm trading if I have a 3% risk in a trade that's already on, and I have another one the same, so I'm risking 6% already if both of them go south, I cannot risk any more than 2% on the next trade that I'm taking. Even though my parameter is 3% on an individual trade, I have an overriding parameter that at a moment in time I'm not willing to risk more than 8% because it happens. Not often, maybe a couple of times a year, but it happens where you're taking a full loss on all your positions, especially if you're in all financials or all grains or all the same kind, where a piece of news would affect all of them at the same time. And usually it happens when you put a trade on immediately, you put your stops in, all of a sudden the market moves against you, and boom, you're out. I don't want to be exposed any more than 8% at any time in my portfolio, no matter how many positions when I consider my portfolio of positions for the moment. You get my gist here. And so you need to have 2 figures to go by. What you're willing to, especially if you trade more than 1 position at the same time, no more than 2 to 3%, depending on your experience of a trade, on an individual trade, no more than 8% on a portfolio. Okay, be realistic. I guess I put 2 4s in this because it's important. Be realistic about the amount of risk needed to make a profitable trade. Don't make a trade fit your risk parameters. I mean, many times you'll be bored with the market and it hasn't worked out for you. You'll look back a couple of trading sessions and you'll know that one particular formation seems to work well, and you'll conclude that formation must work well, and I'll start using it. We do that in trading all the time. Young traders do that. Traders that are just starting out do that. And but it's the same thing when you're dealing with emotion and risk. You think you can handle more than you can, but you can't. Look, everybody has their limits. Even I, the disciplined trader, has his limits, and I make those limits very well known to me. If you look at my trading journal, you'll know exactly what they are and how I pound that into myself, knowing that it's okay to have the short risk limits that I have, and I'm willing to pass trades. Again, I'd rather be out of a trade wishing I was in a trade wishing I was out. So be realistic. Just as you're realistic with developing the parameters, the technical parameters of your trading plan, be realistic about the amount of risk that you need to make that needed to make a profitable trade. Okay, and the conclusion of the rules: reward to risk minimum of 2 to 1, preferably 3 to 1 or higher. So when I'm looking for A+ trades, I'm in the 3 to 1 or higher category. And they can be rare sometimes, but in markets that are moving substantially, sometimes you'd be surprised how many there are. Just be patient. Wait for your time. The markets will expose themselves, okay? Lock in at least a portion of a windfall profit. Again, this is my thing. This is because I do things to maintain my mental fitness. Most people don't look at trading like that. They look at trading first and control their emotions second. I do things that I know work for me in controlling my risk and my mental capacity, my mentality in order to follow my trading plan. Okay, I lock in at least a portion of in every simple. Every once in a while we'll offer simple trading plans to our customers, meaning that they're simple trading plans that I use. Come from my portfolio of trading plans. Anyway, almost all of them. They're all multiple positions, two positions at a time, and minimum. And when you get an initial run in your favor, I'm always taking a profit on that first position. Or if it's 3 or 4 positions, taking 1 or 2, or whatever the trading plan calls for. But I'm always taking a position out on initial confirmation, because I find that when I do that, it empowers me to do the right thing with the remaining position. Okay, that's why I do it. It makes me feel good. I took a profit. I mean, I'm ahead, and now my maximum risk is smaller than it was in the beginning. It's part of the way I handle, the way I act mentally. So there's a lot of people that don't agree with this. I disagree with them. Works for me. Disagree all you want. The more I'll listen. And sometimes I'll change my ways, but not about things like I'm showing you here today. The more active I am, the less I will risk with each trade. I talked about that earlier, where when I'm active, and usually I'm active when I'm winning. I'm in the weeds waiting for the A+ trades when I'm initiating trades. The less I'll risk on each trade. So if I make a trade that's positive early, I will stick with that trade. I will stick with that profit. I'm not willing to give that profit away. It's very seldom that you'll find me making a nice profit on the first day and somehow ending the day without a profit. I'll eat into that profit, but from that's when I start to really get hard on waiting for A+ trades, or I have A+ trades. So I'm waiting for, I'm not going to risk that profit. In our training. And I'm going to offer you that training for $29 a month if you're interested in it. You can quit at any time at the end. I'll give you the link. But in the training, I go through a whole thing. There's a whole hour by a guy that I respect, a guy named Joe Ross. Everybody knows him. He's got to be 75+ years old. He looks like Ahab, but he's one of the smartest traders around, and he's all about framing your trading as a business. And I don't mean incorporating and so on, which can be a smart thing to do for professional traders, of course, if you're going to be moving around any kind of money. But he talks about framing your trading as a business. If you take a profit, that's part of now the business equity. Okay, if you take a loss, that is part of the expense of a business. So when I make something turn on my trading equity, I'm not willing to give it back. I mean, companies aren't willing to just give people their profits. I don't. But so many traders look at it differently. They say to themselves, "Geez, I got a profit. Now, I can take a little bit more risk at some of these trades I really want to do because I can, even if I lose, I'll still be ahead." Nonsense. A trader with proper mental and trading techniques is not going to think like that. But it's common. Believe me, it's common. In fact, you may be thinking it right now, but don't admit it to anybody. Okay, never add or average down to losing position. We talked about that. Be willing to stop trading and reevaluate the markets and your methodology when you encounter a string of losses. That number for me is 6 trades. Okay, I'm going to move a little bit faster here because I want to make sure that I have a little time for questions. If you want, maybe I'll wrap up this presentation in about 7 or 8 minutes. Okay, I want to talk about the gap. This is a concept that I pay a guy $20,000 a year. Been with him 5 years. A guy named Dan Sullivan. From Strategic Coach. He trains entrepreneurs. He's helped make me the entrepreneur I am today. And he talks a lot about the mental concept of being an entrepreneur. Look, I give you this because, to me, I do it because I believe that, yes, I have a business about the mental and emotional issues of traders. Nobody takes on this field of how to help traders to be mentally and emotionally fit. Nobody talks really like I do with this emphasis that I've seen, and that's a business. But my trading is also a business. In both senses, I'm an entrepreneur, and I have other businesses that I won't mention here, but I have other businesses. I've always been a serial entrepreneur, and so trading fits right into that as part of my income stream. So I pay this guy to help me with processes that can help me to keep my head straight and keep moving forward with that positive expectancy we talked about in the beginning. Learning to avoid the gap is one of those things. It's a skill of being a happy, positive trader. And I'm going to go right to the chart rather than all of this. I'm going to define it as we look. Okay, here is just a simple chart, and I don't have a pointer, but I don't think you're going to need it for this. I won't be using this presenter in the future, but I think it'll work for here. If you look at the bottom, what you see on the top here is the ideal. The ideal is something. Think of it as the horizon. It's this great thought of future possibilities for yourself. You're making that $1 million in trading, or paying for your kids' college, and being sufficient as a self-employed trader full-time. That goes on to be a billionaire. You know, these magnificent ideas of ourselves, these billionaire ideas that we all kind of roll our minds into when we start thinking about the potential, especially after we take a nice big trade or had a nice big month. We know that all of a sudden that billionaire title is possible for us too. It's out there. It's like the horizon. You can walk to it and move to it, but you're never going to get it. It's a goal that's now, and the reason I say you're never going to get it, because no matter how much money you make, when you approach that billion, you're going to be going after Bill Gates after that. The horizon keeps moving. That ideal notion of what you can be continues to change as you continue to achieve the steps, or what used to be the former ideal. Okay, and the former ideal because as you approach it, you move the ideal out like the horizon. I think you understand what I'm saying. So when you make a goal, you make a goal that could be equal to the ideal, or could be just short of it, or whatever. I mean, you want to be a billionaire, but for right now, you make a goal for the next 6 months that you want to double your account. Okay, you want to double your account. So your actual at the bottom is where you are right now. That's where you are right now. And being actual at the bottom with a new account open, and you're going to, whatever the goal is, you want to double your money in 6 months. You need a time frame on that goal. Whatever that goal is, after 6 months, you are where you are. Let's say you made 10% on your account, not 100% on your account. Well, actual 2 is where you are after those 6 months. So in actual 1, you're where you start. You set a goal which has a time frame that ends at actual 2. Actual 2 gets measured at the deadline of your goal. Okay, now I'm up 10%. Most people, and myself formerly included, a lot of people will look toward the ideal and say, gosh, I was supposed to double my money or better, and I only made 10%. You know, gosh, is this thing really for me? Look at all the work I did, and all the suffering I made, and all the back and forth, all the money I spent on trading. I never even paid for that. And it's 6 months. I mean, come on, maybe the trading is not for me. That's the gap. That's the gap. That's the area where you're talking yourself down, you're beating yourself up because you didn't realize you didn't reach your ideal or your goal. You want to stand at actual 2. Here's what you want to do. You want to stand at actual 2, and you want to look back at actual 1. Okay? And say, I made 10%. Okay, look at what I learned. I made all of these mistakes, and I still made 10%. I was an idiot, and I made all these rookie mistakes, and I still made 10%. I'm the coolest guy on earth, at least in my earth, in my house, or whatever. I'm ahead, or I lost 10%. I made all of these mistakes, and I still have 90% of my money to go. Next time, I will correct these mistakes and move forward. By standing at actual 2 and measuring yourself against actual 1, it is an empowering thing. By standing at actual 2 and measuring yourself against the ideal, which is constantly moving, no matter how successful you are, is not where you want to be. That's the gap. And I have met so many people with plenty of money that are the most unhappy people in the world. You want to be a happy person. It's not about the money. It's about you being fulfilled and being positive and happy about yourself. I'm most happy when I'm out there gardening and growing my vegetables. Call me crazy, but it's all about what makes you happy. Okay, so I hope you understand the idea of staying out of the gap and framing your experiences with how far you've come, not how far you could have come. If you place yourself in actual 2 and measure against the ideal, you're going to feel like a failure. You're going to be frustrated, disappointing, guilt, depression, low self-esteem, and a slow self-esteem. A slow, low self-esteem, the worst kind of self-esteem. Not only is it low, but it's slow. And I've seen rich people, because it's not about the money. But if we're going to be positive, if we're going to be successful traders, especially newbies, you need to stay positive. You need to have that positive self-esteem. You need to have that positive self-confidence. And you need to be self-motivated to do the right thing, to be empowered. Every motion we make is empowering. That will move you forward. Because if you're at the actual 2, measure against actual 1, you're going to have success, you're going to feel satisfied, confidence, and joy, optimism, and self-esteem. Okay? I hope that has helped you with the positive notion of things. I can't see the responses, but I hope that's really helped you. I want to show you a few more slides, and I'll show you here. I just want to give you a link. Here's the link I'd like to give you. Here's this thing I'd like to eliminate again for the time being. Appreciate how far you've come. We've talked about that, okay? And not how far you're going to go. Let's do it this way. I'm sorry again for my lack of technical, but I still feel good about myself, you see? Write this link down. realtraderswebinar.com. That's the sponsor, of course, Mark and his gang. /disciplined trader. So look at the spelling there, and what you'll see is an offer for $29 a month. I want to give you more of this. You'll get a bunch of download. You can cancel it anytime. You're not, even though people stay for a very long time with us, you're going to get the content for $29 a month for as long as you want it. These mental subconscious trainings, all the other things that I talked about, you'll get that as long as you want. Cancel at any time. We used to give less than this. We keep adding. We used to give this Disciplined Trader Mastery Kit. We used to sell it for $2,000, and we have many, many happy customers that they've been with us so long that even if they added up to $29, they still got a deal way back when. But I'm telling you that if you just look at this and give it a month, risk $29, because I'm not giving it back, incidentally. There's no guarantees. You either have to be proactive and ask your waiter to give you what the chef would like, and be proud to be able to have the confidence to take that leap, because you know you can handle a $29 loss if you were an idiot. Do it, and I think you're going to see that. And when you get there, look at the welcome screen. Here's a screenshot of the Disciplined Trader Mastery Kit. And you can see it has different folders that you can. The welcome folder gives you I give you a 7 or 8 minute video on how to move through the material so that you can get help right now in some of the areas that you want to deal with: patience, taking losses, all the mental and emotional issues. You can start working on that immediately. You see the basic series here. The basic series is a series that we never used to offer, but we added it a few years ago because we were training traders to be disciplined on their trading plan, but they had a lousy trading plan. They didn't even have the basics of risk management and so on. So I hired four hired guns to give presentations on 4 elements that I thought everybody needed as basics, and I just stuck it in there. And they're great for newbies to start out with. One is really based on my book, How to Build a Responsible Trading Plan that works for you. The second is the hired gun talked about risk and money management exclusively for an hour. The other was Joe Ross, who I mentioned, who talked about how to frame your business as a business in your mind so that you're stronger of mind and body to do the right thing and run your trading plan. The other is the last core element is journaling. So journaling is really where you get honest with yourself. Not talking about logging your trades. We'll show you how to do that too, but we'll show you 99 examples of journaling. We'll show you the basics of how to criticize yourself without criticizing yourself, empowering yourself through self-analysis. And I think you're going to that's really some of the favorite people like that, almost better than anything else, of those basic series. And then you get into the core elements, which is really the mastery kit itself. Okay, and here's an example of one of the core elements. This is the one with the least elements to it, but this is the core module 1. They expand in elements. We got so many. We even have a lifestyle section. If you see that on the top right, the right of the tree there, you'll see the lifestyle section. Those are mental trainings of all parts of your life. Better golfer, better sex, better memory, better tennis, better study habits. You got 100 mental training sessions, because these mental training sessions that we give you in the core elements that are specifically for traders, like this one right here, the second element down, always the second element is the subconscious training. The first element is always a little video of me telling you about the elements of the core module, of that core module. But the first real element is the subconscious training, the 7-minute training that I talk about, where you sit there and you relax and you just feed your mind good stuff with my wise voice. And then affirmations to support that. If you want to use affirmations, not mandatory, but we found using conscious training in your car or when you're whatever exercising, the same kinds of suggestion, only you're in a state where you're not relaxed. Using those in synergy really helps out. In this particular module, I want to give you the basics again of trading journal, a primer, the elements that you need to have, and some examples. And of course, in this particular one, I want to start to talk to you about how important it is to pull the trigger and what are the things behind pulling the trigger, which kind of segues from the actual mental training that you're taking. So you got mental, and these there's 6 core elements. This one concentrates on pulling the trigger. There's one on taking your losses. There's a core element on patience. There's one on treating your money as money, your winning as money, and not as just fluff, and that you can lose back. And there's one on sustaining your training, your mental, emotional fitness through the long term, because it's a marathon. So that is really all of my presentation. Here again is the link that I'd like you to go to and take advantage of the offer. So again, $29 a month is not going to hurt you, and I think you're going to wind up being a member for a long time, like so many thousands are. So thank you for your listening, and thank you, Mike and the gang, for having me. Mark, I'm sorry, and Greg, thanks for introducing me with such a great presentation before me.